Gold continues to set a record high, over $2,600. Everything plays to the cards of gold, as well as the interest rates, the geopolitical situation and everything. So what would have to happen so the gold price starts falling?
Well, basically, some of the big drivers we've seen now, literally since, especially since 2022, that they start to fade. But I think unfortunately, you have to say that the reason why gold is up more than 25% this year, on top of gains last year as well, is simply a reflection of the current world global situation. Because what is gold? Gold is not a bond that gives you an interest rate. It's not an equity that gives you dividend. It's simply it's kind of a dead asset, because the only return you make is when the price goes up. So in order for you to buy gold, you really you are basically looking to buy gold alternatively to normal investments, and that reflects, I would say, an uncertain world. You mentioned the geopolitical risk. Central banks are buying gold because they want to reduce their dependency on the dollar. And now on the positive front, you can say we have the rate cuts, because normally in a lower rate environment, gold, silver, and other metals tends to do better. So, but to answer your question, in order for the rally to run out of steam, for the rally to reverse, we need to see some of these developments start to reverse. And for now, the geopolitical risks are still very elevated. We may have a trade war with China. We have an uncertainty about the presidential election in the US. We have a world that is very loaded up on debt. That is, some investors are worried about these debt levels, and that's not going to come down anytime soon. So basically, with that in mind, I think we are likely to see gold continue higher next year. I think for now, we probably run as far as we can. So I'm looking for some consolidation here in the next few months. But I think overall, the direction is still for higher prices.
How high it can go?
That's a good question. Well, so far this year, I've had to revise this year's target twice already. So I was surprised by the strength in the rally. But the next big number, because now we're talking round numbers, because we've never been here before. We are in record territory. So the next big number that people will start to focus on is 3,000, and that's not even 10% away. So that's relatively nearby. So I think with that in mind, I could see 3,000 next year. And if we relate that to some of the other investment metals, because if gold is starting to become expensive, because if you are an investor and you're buying gold, you're basically buying at a record high price. Some are starting to feel less confident about doing that, because you really feel that you may buy the peak of a market. So instead, people are looking at other similar metals, and that's obviously where silver comes in. Silver is currently trading around $30 an ounce. It was trading at $50 back in 2011, so it's still way below its previous record level. So we are seeing silver benefiting from the very high prices in gold. So silver this year has actually done better than gold, and we actually believe next year that silver will continue to perform better than gold, simply because it's relatively cheap compared to gold.
Well, right now the gold are mainly central banks buying. The private investors, for them, it's too high, the price.
You are right. The physical demand right now is coming primarily from central banks. But then we have the so-called paper demand, which is ETFs and futures and so on. There's been very strong demand in the futures market from speculators. But speculators are speculators because they are not there for the long term. They're involved as long as the price is right. If the price starts to turn in the opposite direction, they will be selling, and that will add some pressure to the price. So you are right. We are at the point right now where buyers of physical gold are probably holding back a little bit, because they have to get used to these higher prices. If we don't see a correction in the next 3 months, then probably they will start to buy again, because then they'll feel more comfortable that these levels are going to be okay for the longer term as well. So right now there is a battle between the physical, which is weakening, and the paper, which is still quite strong.
What would have to happen so the gold price would start falling right now?
For the gold price to start falling, simply that we may have a change in the outlook for interest rate cuts in the US. Right now there's quite an aggressive amount of cuts priced into the market. If the economy, U.S. economy, remains stronger than expected, then that could lower the pace of rate cuts. That could potentially be a trigger for some profit taking. Obviously, in the best case scenario, if we have a solution to some of the geopolitical events we have right now, obviously Ukraine and the Middle East are the two things that we focus on. That could send prices lower again. But apart from that, I think it's mostly due to how the dollar will perform in the short term, because the dollar has also been weakening this year, and a weaker dollar tends to be positive for commodities, especially something like gold. So if for any reason we have a stronger dollar, then we could also see a trigger. And then we have to remember that there's a lot of speculators in the market, and if we start to see weakness, they will start to sell, not necessarily because they think it's not going to go up again, but because they have to adjust their risk. So that could lead to a situation where we may see a $100 to $200 correction in the market. But again, it's relatively small compared to how far we travel this year. But so I'll look at the economic outlook in the US and the travel, the speed of rate cuts, and the dollar.
You said the price of the gold could reach 3,000 soon. Could it be 5,000?
Why not? If it is, if that is the direction we're going in terms of worries about other markets, then obviously it can happen. This year we're trading. I was trading gold 20 years ago when it was trading around 300. Now it's trading closer to 3,000. So over time, what we've seen, and that's obviously again one of the beauties about investment metals, is that over time you keep your purchasing power. That the value of gold today is equally or higher than the value of gold what it was, say, 100 years ago. So you've been able to maintain your wealth by holding gold, and those qualities are not going to go away. We haven't talked about the Chinese middle class, who have also been buying very strongly in the physical gold market, simply because they used to invest in properties and in the stock market for their retirement. Both of these have up until recently been struggling, and that means that a lot of the middle class well-off have been buying into the gold market as well.
Well, maybe the situation in China will change, so they will stop buying gold.
if they have
invest again.
Again, that could be one source of reduced demand. If they feel confidence that coming back to the property market, that you're not going to lose money by buying a second home as an investment, and the stock market starts to look more healthy. Yes, that would be one source of less demand, but against this, we have I would say the big bias from the central banks, and what the central bank, and the big change that happened in central bank buying was the invasion of Ukraine, because what it led to was the Russian central bank had its assets frozen in dollars and euros. And that's basically sent a bit of a shiver around across the world in other central banks. So basically this de-dollarization, removing or reducing your exposure to the dollar and holding something tangible such as gold, that process I think is ongoing, and that will probably continue in the coming years. And central banks will perhaps look at the price right now and say, let's just hold back, see if the price come down a bit. But I think the process of buying gold in order to reduce exposure to other assets, I think that will continue, and that will continue to be an underlying source of demand, which is helping to keep a floor under the market.
So, and what about other commodities? We hear a lot about lithium, how the demand is going to make batteries cheaper, but why should it get cheaper when there is a high demand?
Lithium I think is still to a certain extent suffering from its own success. The fact that we had a massive run-up in prices a few years ago basically meant that a lot of production was made available. So suddenly supply started to increase very rapidly. And it basically reached the point where the supply was outstripping demand, and prices has collapsed, and we're still struggling really to get going. there is a little bit of a plateauing with regards to electrical vehicles in certain parts of the world, and that basically also means that the production of batteries and thereby demand for lithium, the strength in demand is potentially going to be somewhat slower than what we have seen. So for now, the only way I think we can see higher lithium price is simply by producers cutting back production to stabilize the price. A bit like we've seen the oil price with the OPEC cutting production in order to stabilize prices. I think we are seeing some signs of that already, but it will take time because some of the costs of these mines are relatively, or the production is relatively low. So they're still making money even though prices come down to these levels. But in the coming period, I think it is the supply side that needs to respond, because the demand side looks relatively weak at this point in time. EV sales, it's been massive in China. I mean, China this year, half the new cars are EV, electrical vehicles, are hybrids. We're not seeing the same extent in rollouts across the world. That basically means that battery production has reached a little bit of a plateau where demand is not strong enough to support further expansion of battery production. Thereby also the demand for lithium is not strong enough to offset the increase we've seen in supply. So that's why probably focusing on the supply side. But over time, I think we also still, with regards to this whole electrification, I think there's still a lot of people who don't feel comfortable that we are there yet in terms of the battery, the time, the length you can drive on one charge and so on, that we need to see some further developments and further improvement in the life of a battery and how long you can drive on the charge and so on. And but that will come within the next few years. But and then the question is obviously whether new technologies arrive which will make lithium less or which make a battery producer less dependent on lithium compared to other commodities. But it's an evolving market. There's a lot of things happening at the same time there right now.
And what about other commodities? What should we expect next year? What should we focus on?
I like to have the broad focus, because if you just look at this year, if you look at some of the major commodity indices, they're currently up around 7%. It's not great, but it's fairly good because we had a good year recently as well. But if you look at how this 7% has been made, it's been made with very strong gains in precious metals, in industrial metals, soft commodities, cocoa, coffee, and sugar has all rallied. And then the other end, we have grain prices, corn, wheat, and soybeans have been under pressure, as well as the energy prices, as we talked about. So I think from a long-term perspective, I still think that commodity prices will move higher. Not only because it's depending on demand. Demand can always be discussed because that's economic activity dependent, but supply can also be an equal forceful driver of higher prices. We're seeing that in the mining industry, where it's become more expensive to mine. We're seeing the time it takes from you find a discovery to you can actually get the metal out of the ground is now for copper 12 years. So it's a long time, and it basically means if you're a mining company and you need to, and you want to invest in a mine, you need to figure out what prices will be in 10, 12 years time. I mean, it's difficult enough to work out what it is next year or next month, but 12 years out. And that basically means that the appetite for new investment is relatively weak. So over time, the supply side of some of the key metals, especially copper for the electrification, could suffer, and that will drive prices higher. Weather-wise, we are not in control of in any way of form. We've seen some very volatile weather again this year, primarily on the southern hemisphere and in specific areas. That's why coffee prices are very high due to drought in Brazil and Vietnam. That's why cocoa prices are up more than 160% because of the Ivory Coast and in Ghana. We have sugar prices due to fires in Brazil. So we're just having a more volatile weather situation, just all the flooding we just seen close to here. And that makes me, that basically leaves the risk of in terms of price skewed to higher prices. But if you want to put me on the spot and ask for specific commodities, I would say I would still hold on to my belief in precious metals, simply because of the world we live in, and no clear signs that things are going to get better in some areas. And then some of the industrial metals where we're focusing as much on the supply side as the demand side. So these are metals primarily. And then they're still struggling to see why gas price in the US is trading 20% or 80, well, a fifth of the price we pay in Europe. They have a massive rollout of data centers towards AI. Some of the states are being overwhelmed by the massive increase in demand for electricity. That will require more wiring. That will require more energy to produce that power. Gas is a natural source of that. We are buying more gas, so I think US gas prices eventually will go up as well.